Hello, this is John Smallwood, Certified Financial Planner, Senior Wealth Advisor at Smallwood Wealth Investment Management. Today we are continuing the conversation on the Wealth Curve Blueprint, our tool that really helps you get a complete snapshot of your income, your savings rate, your tax rates, your lifestyle rates, your current assets, your current liabilities, your future liabilities, your defense from a life insurance, disability, a long-term care, future pensions, and wills and trusts and umbrella liability policies. As we've been talking about, is that the optimal mix of all of those financial decisions is going to help you create a more successful plan. When we talk about the Wealth Curve Blueprint, if I have on my plan that I want to pay for my kids' college. I want to pay for 100% of the kids' college, 50%, none of it, 10 grand a year, 20 grand a year. It's that optimal, what is it that I want to do in my plan? And I say this every single day. Your plan is your plan. It's nobody else's plan but you. You have that fingerprint. That fingerprint is unique to you. Your financial plan and the makeup and the dynamics of your plan are yours. So if you say that I have two children, they're 2 and they're 4, and I want to pay for those kids to go to college. Well, in today's dollars, depending upon where you want those kids to go and what you're willing to pay for, it's going to be, somewhere between $40,000 and $70-something thousand a year. And that's going to go up somewhere between 2 and 5% based upon what we're seeing. Now, there are a tremendous amount of ways to get scholarships and to get school funded and paid for through different sources. But most people are either writing a check or going into debt somehow to pay the school. They're not getting all of those unique benefits. What's your job going to be? Are you going to work in a nonprofit? Are you going to, what are you doing? Can you go to a community college for 2 years and then shift to a better school, where you're going to have not necessarily a better school, but a school where you're going to get your 4-year degree from? We're not here to talk about what the right strategy is, because that's unique to you. But what we're talking about is if I said I want to pay for my children and it's $250,000 per kid in today's dollars, let's use that example, and they're a year out. I have twins and they're a year out. Let's just pretend that for a second. I don't have twins, but let's say that I do and they're a year out. I really need the majority of that money to be funded right now in today's dollars, or be able to pay for it out of cash flow, or to pay for it from student loans. But I need to have, if I've said I wanted to do that, I need to have that amount of money funded today to get through that. Now, if the children are younger, what you want to understand is how much of the current college plus the savings that are dedicated to that liability that you said that you want to do, how much of that currently is going to get you to that goal. And we're looking at that goal and saying, if the child is just born, it's 18 years to the goal. So I have $1 put aside for that kid, and I need to basically, without inflation, spread out that money and make sure that I put away enough money every single year, then factor in inflation and then factor in growth rate, and you're planning for that kid's college. What I have found is that for this to be optimal in your plan, you really need to be looking at the retirement goal, the current goal, and understanding how do I put money aside so that I can pay for the kids' school and it doesn't take away from my retirement. Because it's going to take away from your retirement, but how do I put my money aside so that when I get to retirement, I can still maintain the level of lifestyle that I've grown my income to and my lifestyle, that I'm not going way backwards, okay? And a lot of people don't do this. So the thing that I want to be focused on when we're building the blueprint is what percentage of that goal do we currently have covered, and is the savings rate dedicated to the college the right amount of money, and what tools am I taking care of so that if there is some sort of exponential technology that has made college free in the future, that I'm not paying lots of unnecessary taxes and fees to take that money back. So optimally, college savings becomes super important.
Welcome to the end of the video. Smallwood Wealth Management is an investment advisor representative. The opinions expressed by Smallwood Wealth Management and guests on this show are their own. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented for this educational purposes only. Moreover, no listener should assume that any discussions or information presented serves as a receipt of or substitute for personalized advice from Smallwood Wealth Management or from any other investment professional, and is not intended as an offer of solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Smallwood Wealth Management is not a law firm or an accounting firm, and no portion of this presentation should be interpreted as legal, accounting, or tax advice. Information expressed does not take into account your specific situation or objectives and is not intended as a recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Thank you for listening.